Has China done enough to reassure the markets with yet another promise of stimulus? That's what we're going to be focusing on today on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. It's been a busy week of data from China, lots of news to pour through and lots of ways to look at what is developing in the world's second largest economy. But perhaps the biggest news that we got at the beginning of the week was another bit of supporting information from the Politburo, which is a 24-member committee at the core of China's leadership, including President Xi Jinping, that seemed to offer another little ray of hope about policy stimulus. Now, the first bit comes from the monetary side of the equation. We can see here there's a helpful graphic from Bloomberg that has put together how China signals its policy intent. So we can see here that from 2011 to 2024, the sort of official moniker for this was a prudent, quote unquote, monetary policy. And what this announcement from the Politburo suggested was that in 2025, we will transition to moderately loose monetary policy. Now, of course, that is sounding much more downbeat and much more modest than what is actually implied, because, of course, the last time things were moderately loose was the GFC and the Great Recession. So the markets ostensibly looked at this and said, well, they're really going to turn the spigots on now. They're going to shower this market with money. But history does not quite suggest that the markets would find favor with that assessment. So here's another helpful chart from Bloomberg showing what moderately loose has meant. We can see here dramatic rate cutting against the backdrop of the global financial crisis. So as we get into this moderately loose period, there's a sharp cutting of rates, and then rates remain low until we basically get into the prudent phase. But of course, that has not stopped China from aggressively easing in this phase. And indeed, you can see here, really from the start of COVID, of course, but from right here in 2022, most aggressively, China starts to cut rates. And of course, we've witnessed ongoing escalation in this sense. There has been ever more monetary stimulus that has been unveiled last year and quite a few times, as a matter of fact, this year. September was the last big splash, and we've since had more and more and more. We've lowered interest rates. We've lowered the reserve requirements for banks, which, of course, free up, or at least are meant to free up more capital that can go toward investment and spending. And we've seen a whole host of other measures, from shoring up the housing market to outright buying stocks, and thereby creating a level of, or attempting to create a level of upswell in consumer confidence to get people to spend, to get businesses to invest. So there has already been a tremendous amount of monetary stimulus. And the response has plainly underwhelmed. What we find is that when we look at how lending has worked in China, this is the Bloomberg Credit Impulse Index here, and what this measures is the share of new loans in GDP and overall economic growth, in other words. And we can see here that since the beginning of the year, essentially, this index has actually declined. Moreover, it is now this level index at the lowest levels we've seen since back in 2018. And the size of these declines is eye-watering, to say the least. The most recent numbers from October give us a 14.5% decline year on year, which was the fastest drop since February of 2022. And interestingly, of course, this is where in 2022, the beginning of it, where the rate cuts really start going. In other words, we don't really have much to show for this stimulus. In fact, things appear to be going exactly the wrong way. Now, what markets seem to again find a little bit enticing in this Politburo announcement was, again, a dangling of some kind of fiscal rethink. The statement from the Politburo saying that officials are looking to be more proactive with fiscal policy next year, which, of course, has been a major source of consternation for market watchers that have looked at China and said, well, obviously this monetary stimulus isn't working. What needs to happen is there needs to be a fiscal effort to actually create demand. And that, of course, has been the core issue in China, an absence of demand. In fact, if we look at this chart that we like to revisit periodically, this is China's GDP growth, nominal versus real, and then the spread between the two. What we find in the past 6 quarters now, so a year and a half, we've had real GDP running faster than nominal GDP. Now, let's unpack this arithmetic. Nominal GDP is the sum of the value of all the goods and services that are produced in the economy. But when you measure their value, there's obviously an element of inflation there as well, which can make the sum appear bigger than the core value of the underlying output. And so real GDP seeks to take out the inflation component, the price movement component, to get just at that. So nominal minus inflation is real, which means if real is running above nominal, then the inflation coefficient is negative. We're subtracting a negative number from nominal GDP, is the implication here. And that's this spread, which you can see is now in negative territory. But consider what this means. Economy-wide price growth is negative. That essentially means the whole of the world's second largest economy has been relegated to the discount bin. When there is demand, that demand tends to push prices higher as that demand chases the supply of goods. That demand competes on price for who will get the goods or services. And that gives you positive inflation, which comes hand in hand with demand and with economic growth, more baseline. What we're witnessing here is the opposite. There is no demand, or at the very least, it is incredibly anemic. And so things are being discounted to try to stoke that demand. An economy that's stuck in a deflationary spiral is essentially signaling that it badly needs for someone to be a source of demand of last resort. And of course, when we saw the same thing during the COVID lockdowns in the West, say the US or Europe, there were vast government outlays to get things moving while there wasn't that demand from the private side of the ledger. this has been something that China has vigorously resisted doing, even as it's promised tinkering at the margin fiscal measures like easing the credit position of municipal governments to perhaps let them spend more, uh, lowering the ratios on down payments for housing to, again, try to induce people into markets. But what we end up with still is the apparent lack of uptake. As a matter of fact, a survey from the PBOC, China's central bank, showed that when asked what urban depositors would do with incremental money, they chose saving by a factor of close to 60%. Moreover, bank deposits are at record highs, which essentially means that all of this monetary easing, all of this provision of cheap money, cheap credit inducements is not creating demand. It's not creating loan growth. People are simply just stockpiling the money because ostensibly there is no confidence for demand and for risk appetite to rebuild. So what happened when China seemed to kind of tease more fiscal stimulus this year? Well, back in September, this was, of course, music to the market's ears. They soared almost 40% in China. This is the ASHR ETF that follows China's benchmark CSI 300 index. Those are the top 300 names listed in Shanghai and Shenzhen, essentially China's version of the S&P 500, a kind of catch-all equity index. Rapid expansion here, obviously, the first time China seemed to float this idea out there. And when it turned out that the measures that were on offer were going to be underwhelming, when we found that what the government actually had when it was talking about these things was a plan to buy up idle land and commercial properties, a plan, as we just mentioned, to shore up municipal finances. All this, again, started to look like inducements for everybody else to spend, but for the central government in Beijing. And once it became clear that a big fiscal package apparently wasn't coming, this move shed half of its advance very quickly. This big decline happens over just a week at the start of October, and then we settle in this narrow range. This was this week's announcement. So there was a bit of optimism, and that quickly faded, and we find ourselves anchored in the same area where we've been. In other words, the markets are looking at this, and they're simply not giving Chinese officialdom the benefit of the doubt until, frankly, they put up or shut up. Economic data coming out of China was also disappointing this week. We started the week with inflation data and had a set of trade numbers that came out later in the week. Here's the inflation data. It ended up being disappointing. We had a set of CPI numbers that gave us inflation of 0.2% year on year. That's the weakest in 5 months, whereas economists were looking for a 0.5% rise, which would have been an increase on the prior month. And of course, wholesale inflation, the PPI component, continues to be below zero, so continues to be in deflation territory. In other words, there is very little demand in this economy, and when it comes to the consumer side of things, we're basically at standstill. On the trade side of things, it was even less encouraging. Exports grew less than expected, 6.7% year on year against expectations of 8.5%. So that pop in exports that we saw in the prior month in October widely attributed to importers, primarily from the U.S., but other markets as well, trying to front run what might be aggressive tariffs from the incoming Trump administration, trying to get their Chinese imports in before those things pick up the price of imports from China for U.S. importers, because, of course, it is U.S. importers and indeed importers elsewhere, but certainly not China, that pays these tariffs. One country can't compel a sovereign other one to pay a tax, and so what we end up with when we have a rise in tariffs is essentially a consumption tax on importers from whatever country is hit with tariffs. But these are domestic firms that have to pay it, and there was a big over 12% year-on-year jump in exports in October that widely was attributed to people trying to front run those tariffs. What we have now has been essentially export growth that's been cut in half in terms of its speed, and needless to say, a disappointing outcome in its own right. But it was imports that really shocked the system. They were expected to rise 0.3%. Instead, they fell, and they fell hard, down 3.9% year on year, and an acceleration, an escalation, as a matter of fact, after a 2.3% decline in October. Again, stressing this idea that demand, especially on the consumer side of things, is woefully weak. It's not just Chinese markets domestically that got the memo here with this anemic response here. We can see China-sensitive assets, a similar response was there. So here's copper. China is the world's largest importer of it, and it is looked at as a proxy for China's business cycle. We can see it popped at the beginning of the week, but has since gone nowhere. As a matter of fact, has made a bid to erase pretty much half of this initial move. The Australian dollar has fared worse. It popped higher again at the beginning of the week, much as copper did, and has since given up all of those gains, and now looks like it's going to close down on the week fractionally. Although, of course, we still have a day left, so we'll see. But clearly, whatever pop there was to have from this Chinese news did not assist and did not hold. And, of course, to some extent, a slightly less hawkish RBA helped on that front when they announced policy this week. But were China's news impressive enough to overwhelm that? It might have, and very clearly it didn't. So, perhaps the only impact that we really saw stick with markets and get market confidence this week was a move in gold. And it's because we got foreign exchange reserve data out of China over the weekend showing that for the first time since April here, China has resumed accumulating gold reserves. Now, we can see here that from 2022 through 2023 and going into the beginning of this year, China accumulated a massive amount of gold. And that, of course, helped to give us periods where gold would ostensibly decouple from macro dynamics and ignore, say, rising yields and a rising US dollar at the beginning of this year. Because through this period right here, China was still aggressively accumulating. After this pause, this bit stands out and, of course, suggests that given how long the previous run looked, given sort of the 18 months of accumulation that was there before the pause, that perhaps another long cycle is underway, and that certainly gave gold a bit of a lift here. It's correcting slightly if we look at today's price action, but the overall break here out of this consolidation and this narrow range clearly inspired and following along, because of course yields are again higher this week, as is the US dollar for the most part. That should be kryptonite for gold, but nevertheless, it is on pace for healthy gains this week. So perhaps the markets will eventually benchmark the full stock of Chinese negativity from economic data and lackluster stimulus efforts, or perhaps officials will finally step up. But as it stands, the only confident thing that the markets find as far as Chinese policy is concerned is their attempt to buy more gold for their reserves. As for the reviving of the economy and everything related to all of that, markets don't seem to put much into those efforts until they see something actually materialize. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things may go therefrom. I am likewise on with Chris for Futures Power Hour, Mondays and Fridays, though we'll be off tomorrow. I am also on with Victor Jones for The Price of Truth on Wednesday, back with him and Tom on Sundays for First Call at the open of global markets in Asia and the futures open in the US, writing for the news and insights portion of tastylive.com and opining on the platform formerly known as Twitter, as well as now on Blue Sky at Ilya Spivak. Thanks very much for joining. Macro Money's back next week.